Come on, 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Tuesday, March 22nd, 2022. And our top story today, retail investors are dropping out of the stock market. Joining me now to discuss this and a lot more, Tara Falcone is the founder, chief executive officer for Reason. Tara, great to see you. Thanks so much for joining us again on the program this morning.
Yeah, of course, Jeffrey. It's always a pleasure to be here. Thanks for having me.
Yeah, it's great. And I love having you on because you bring this rich perspective as a person who has worked with other people, trying to get them to learn about finance. But also you're an entrepreneur. You've built Reason into a very far-reaching platform. So it's great to get your perspective. So let's talk about something that you and I have talked about throughout 2021 and probably back into 2020, which is the growth of retail investors. We talked about Reddit threads and why people were jumping in. Now it looks like the number of retail investors is actually contracting. They're dropping out of the stock market. Thoughts there?
Yeah, I think it's a kind of a 1-2 punch, if you will. You've got people really going back to work. And so, they've got a lot less time on their hands to be speculating in the market. I also think that the, big sort of like exuberant joy and excitement and interest in retail investing has kind of gone away. There are, of course, still meme stocks. I mean, you see what, AMC recently did, buying some mining company for whatever reason. So that's still happening. But I think that largely the bulk of that interest and, this sort of like gold rush, if you will, to grab any alpha that they possibly can has really tempered. And so I think you're seeing people starting to buy things and hold on to them for the longer term. There's a lot of worry, of course, about what's going on with Russia and Ukraine and other areas around the world. And so I think retail investors are kind of taking a bit of a breather right now, reassessing the landscape, really figuring out what exactly their investing goals are, why they're investing in the first place. And then they'll, maybe make some strategic moves after the fact. But I think a lot of people are just sort of, sitting around waiting and seeing, and are now preoccupied with other things.
I would agree with you, and you're a lot closer to it than I am. And I mean, does it give you a sense of reassuredness that maybe people are buying and holding, and they're looking at the long term? So we're not seeing the volatility, the volume of the trading that we saw before, and maybe people are like, you know what, buy and hold, dollar cost averaging, however you want to define it. It's a much better strategy than going for the latest thing. And you made the illusion or the metaphor of using the gold rush. I mean, how many people went out west looking to strike rich with gold and were left with nothing but dirt, sand?
Yeah, absolutely. I think, I'm always at war. I have two sides of myself. I have the financial planner side, which is, buy and hold long-term diversified portfolios of ETFs. And then I have the former hedge fund analyst side, which believes in active investing in inefficient markets. And so I think there is a place for both in somebody's portfolio. I think, when you're investing for something that's very long-term or incredibly important, meaning like if you lost that money, it would really not be great. Then yes, a diversified portfolio of ETFs and buying and holding is probably the better strategy for you. But that's not to say that there aren't opportunities in the market that are shorter term, meaning anywhere from 6 months to 5 years away, where you could generate outsized returns to achieve very specific financial goals that you're investing for. And so, on the one hand, yes, I love that people aren't just throwing money at the wall or throwing spaghetti at the wall and hoping something sticks and they become a millionaire overnight. But on the other hand, I think that there's still opportunity there, and you're still seeing investors, engaged. But ultimately, I think what it's going to result in is sort of a reckoning for the companies who are generating revenue via payment for order flow, like Robinhood, for example. They did incredibly well in 2020. Their accounts, increased tremendously, as did their bottom line. Top line, not necessarily bottom line, but now, you look at their fourth quarter results and guidance, and they're a little concerned, I think, about the trading activity going forward.
Yeah, and I don't mean to say that my comments said that active investing isn't appropriate. I meant instead of trading every day like they were doing the machination, that maybe it's a bit more prudent to buy something you really, really like and have done a lot of research on. Let me ask you this, Tara. How much of the inflation that we've seen, maybe people don't have the discretionary income to necessarily be buying on a regular basis. We've seen gas prices, food prices, just about everything that we consume on a day-to-day basis as individuals going through the roof. And would that have something to do with it as well?
Yeah, I think the inflation impact on retail investor behavior is really fascinating because, as somebody who I'm in California, our gas prices are over $6 a gallon right now. It's absolutely bonkers. And wage inflation is not keeping up. And so you've got sort of this weird, dual components at odds here where it's like, well, you've got these inflationary pressures. People may not have as much discretionary income because they're, having to pay so much more for groceries, gas, et cetera. But they're also on the other side thinking like, how can I possibly afford my lifestyle going forward? Hoping that my company increases my salary enough over time to cover these expenses. And so actually you've got less discretionary income, but perhaps more interest in investing as a way to be able to afford the things that they want to afford. And so, yeah, it's kind of interesting. You see some people that are terrified. And so they're staying out of the market and just hoarding cash as much as possible. And then there are other people that are like, well, geez, if my gas bill has gone up this much just to commute to and from work, my company's not paying me anymore. I should maybe look to invest some of my cash in order to help, cover this additional expense. So it's really interesting, the kind of two camps that we're hearing from, and it'll be fascinating to see how that shakes out.
Last question for this segment, Tara, and that is, yesterday we had Bob Colley on from Colley ESG talking about sustainability. We talked about the impact of the war, how that may redefine or change some of how we think about sustainability, ESG. A lot of people, especially you talk to younger people, they're really focused on ESG and sustainability. I wonder how much of the retail investor mindset has changed given all that we're experiencing. You've got the war, Russia invading Ukraine, you've got gas prices, oil prices, food prices going through the roof. Has that changed in your estimation? You're a lot closer than I am, as I said before. The retail investor, are they focused on ESG, sustainability, or has that been maybe compartmentalized and pushed aside a little bit in the short run?
Yeah, I think it's interesting to in times where things are great and you maybe have more time to think about the, potential climate impact of your investments and what's actually in your portfolio, you can be a bit more strict about maybe, what's in your portfolio. I don't want to invest in fossil fuels. I don't want to support those companies, especially not any in the United States. We need to catch up and not produce our own oil and think about going more green and what have you. But then now all of a sudden it's like, oh, well, we haven't done that and we're not getting oil from other places that we deem to be okay to source oil from. So actually, maybe we should be throwing a little more money at those companies to produce more domestically. So there is a bit of a switch there, but I do think long term, this new generation of investors, especially, are very concerned about where their money is going, even though they're not directly, they're not like actually giving that cash to those companies directly. It's a secondary market, but they do feel as though they're kind of voting with their dollars. And I don't think that's going away anytime soon. And we see a lot of additional startups popping up that have more of an impact focus for retail investors.
Yeah, I think it's just the same mindset you were describing earlier, the short term versus the long term. The long term is we all live on the same planet. As far as I know, we're not leaving for another galaxy far, far away, not just yet. But yeah, fingers crossed on that.
Right.
Tara, I need to take a quick break. When we come back, we'll talk about buy now, pay later loans appearing on your credit report. What you need to know. You're going to stay tuned. You're going to want to stay tuned, I should say, right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Tara Falcone of Reason this morning. Tara, thanks so much for staying with us this morning.
Yeah, of course. Happy to provide my voice of reason on all things finance.
You are the voice of reason. We're gonna use that as your entry next time. Your invitation to the program. All right, let's entry to the program. Let's talk about buy now, pay later. And for a lot of people, this is like every time I go to buy something on Amazon or another site. We're not promoting Amazon, and they're not a sponsor for that matter. Hey, if they want to, that's fine. But you see, right? I mean, they have a lot of money. But you see where there are buy now, pay later options, and it turns out that isn't a panacea either, Tara. We've seen debt go up for people, but these buy now, pay later loans are going to appear on your credit report. That's going to have an impact.
Oh, absolutely. And I think that consumers that have been using these buy now, pay later programs are shaking in their boots a little bit about what exactly that's going to mean for their credit score and, home affordability and, loan qualification and all of these types of things. I think it's interesting. I saw something a while ago where it was like, oh, even like a pizza company like Domino's was allowing you to buy now, pay later. And it's really like eat now, pay later, which is sort of strange. I've been very concerned about buy now, pay later for years, thinking about, how is this really going to affect the average American's debt balance and debt to income ratio? Because, you see these like little micro loans and, $5 to $50 a month to pay for this item seems like nothing, like it's the cost of a coffee. But then all of a sudden you're doing that over and over again on site after site after site for purchase after purchase. And racking up these enormous liabilities really that just are in the form of micro loans. And so now, people are, I think, going to be very surprised about what exactly all of those, micro purchases have really meant for and how that will impact their credit score going forward.
And look, I mean, I agree. And you always have to think about when you're buying, and I'm not lecturing. I mean, this is just the reality of how the world works and how finance works. I mean, everything has an impact. If you take out more loans, you look at your credit report, you can go to freecreditreport.com or .org, whatever the site is. I'll let people Google or try to figure that out. But there's a lot of components to that credit report. There's the frequency by which you make payments. There's the amount of debt to equity the ratio that you have. And then there's the length of credit history that you have. And while it's great to build credit, you don't want to get in a position, Tara, where you're overextending yourself and then, hey, you're on the hook, especially with rising interest rates, Tara.
Yeah, absolutely. And I think, one of the other components of your credit score is new debt. So how frequently are you taking out new debt? And that's why, every time that you go to a cashier at Kohl's or TJ Maxx or wherever, and they ask, oh, do you want to take out or open a new credit card to save 20% on this purchase? You should really be saying no, because the more frequently you do that, the more risky you look to lenders, because it seems as though you're trying to take out new loans very frequently over and over again. And so, yeah, I think that's going to have a negative effect. I think that's going to decrease people's credit scores over time because of that new debt that they're taking on. Ultimately will likely be reducing their credit worthiness, over time. And as you mentioned, you kind of have to think about, why exactly are these companies making this available to you? Because they want to sell you something that you wouldn't otherwise be able to afford potentially, right? They're trying to increase their top and bottom lines. And by doing that, allowing you to effectively pay in increments or installments for this particular item that, again, you may not have the full cash balance on hand to pay for. So to me, it's debt just disguised as affordability. And it's a worrisome aspect of lending these days, in my opinion.
Yeah, and I like that you said it's debt disguised as affordability. Debt really can weigh you down in a lot of ways. You and I have talked about student loan debt, but there's other forms of debt. There's buying that car. There's, unless you can pay cash for it. There's buying a home, unless you can pay cash for it. But all these things have ramifications, and the best interest rate you're going to get is based on your credit worthiness, what your credit score is. That really, and your income, and that's going to be the driver, one of the key drivers of what interest rate you get for some of those bigger long-term assets. And by the way, mortgages appreciate. That car you just bought or the computer you just bought, as soon as you got it, depreciation city.
Yeah, and I think the interest rate hikes are going to be interesting in terms of how they affect buy now, pay later. There are many aspects or purchases that you can make at actually 0% interest rate, depending on the amount and what you qualify for. I would imagine that as interest rates increase, those companies aren't able to borrow money at that same low interest rate. Their costs have now gone up, and they might be passing that on to the consumer. So you may be seeing these 0% rate loans for buy now, pay later programs going away. Can't speak for any of the companies, but I would imagine that that's something that they're, factoring into their calculation these days. And so, if you've got somebody who, was thinking that to buy this $2,000 item and, I can pay it off over the course of 24 months with no interest. Well, now all of a sudden, if there's, 3-4% interest tacked on top, they're not only, buying something that maybe they can't afford right now, but they're making it harder for themselves to afford it over time, because they're actually going to pay more for it over the course of those installments. And so, fascinated to see how it works. I also think consumers really just don't understand how interest rates really affect the people who are borrowing and lending that money, and just how the money system works in the United States. So it would behoove them to understand how those funds flow and how it ultimately affects their wallet.
Well, I think you certainly made the case for more financial literacy, continuing education when it comes to financial. And we can all, by the way, you, I, you, me, everybody, we need continuing education to remind us of the principles of good investing, good budgeting, and making sure that you understand how to manage that checkbook. Because, Tara, not all debt is bad, but you don't want to get yourself too overwhelmed where you don't have enough equity to offset it. Tara, we're going to leave it there. Really great to see you. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Same here. Thank you so much.
And that wraps up this edition of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more in all one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content? Search our archives. We'll check out our website and our streaming partners like Amazon, Roku, Samsung, over 100 more. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired, come on.
Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited And do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.